All right, pull up a chair and let's dive right into this consultation. Today, we're mapping out exactly how we're going to build your financial future using this ultimate wealth building explainer. Imagine you and I are sitting across a desk from one another right now, and my absolute only job as your advisor is to make sure you keep the money your investments actually earn. We are going to completely rewire how you think about the stock market. We're stripping away all the noise, the outrageous fees, and the gambling to reveal the raw, unvarnished truth about building lasting wealth.
So, what if I told you the absolute secret to building incredible wealth was, well, doing absolutely nothing? Sounds crazy, right? But to understand this, let me tell you the parable of the Gotrocks family. Imagine this massive, extended family that essentially owned 100% of all American businesses. For decades, they grew massively wealthy just by standing totally still and collecting their share of the dividends and earnings growth. It was a perfectly positive-sum game. But then, they made a fatal mistake. They started paying helpers, brokers and active managers, to trade shares amongst themselves. The businesses didn't actually make any more money, but suddenly the family had to pay fees, commissions, and taxes. By trying to outsmart each other, the family's total wealth actually began to shrink.
Okay, let's move right into Section 1, Wall Street's Casino, the loser's game.
Now, there is a vast, absolutely crucial difference between casting your lot with the real growth of businesses versus treating the stock market like a giant voting machine or a Las Vegas casino. Real investing, that's a positive-sum game. Companies create products, they generate profits, they pay dividends. That builds real wealth. Speculating, on the other hand, is just trying to guess what someone else is going to pay for a stock tomorrow. Before costs, speculating is a zero-sum game. Literally, for every winner, there is an equal and opposite loser.
The legendary John Bogle hit the nail on the head here. He pointed out that constant emotional market activity is just a losing game. Wall Street is basically just an arena for pushing poker chips around the table. And here's the kicker. When you actively trade, you're paying a toll to the house. The brokers, the fund managers, the taxman, they all take a cut. Just like in a real casino, the house always wins. In active trading, those financial intermediaries always win. When you look at the data here, you see that beating the market averages is incredibly rare. And why is that? It's because high transaction costs physically shift your probability of success straight over to the losing side. In some theoretical, cost-free world, sure, half the traders beat the market and half lose. But once you subtract management fees, bid-ask spreads, and trading commissions, that whole curve shifts to the left. That zero-sum game instantly becomes a loser's game for the vast majority of people playing it.
And this is exactly why we do not gamble on single stocks. Have you ever heard the term creative destruction? It's just the natural cycle of capitalism where failing, outdated companies die out and get replaced by innovative new ones. Because of creative destruction, picking individual stocks is incredibly risky. I mean, you might accidentally pick the next Blockbuster instead of the next Netflix. It is infinitely safer to just own all the companies, capture the overall growth of the market, and let capitalism do all the heavy lifting for you.
Which brings us perfectly to Section 2. The magic of compounding, making money work for you.
Check out this timeline. It's honestly like magic. Even starting on a modest $25,000 salary, if you save just $2,400 a year for 45 years at an 8% average market return, you yield a staggering $1 million. This is the absolute miracle of compounding. Your money makes money, and then, get this, that new money makes even more money.
Now, focus on this jaw-dropping number for a second. $469,000. That represents what a single, one-time, $10,000 investment grows into over 50 years at an 8% market return, assuming zero costs. It proves that time is literally the ultimate friend to the patient investor. But, and this is a huge but, this assumes you actually get to keep all the returns those businesses generate.
So where does this growth actually come from? True wealth over the last century was driven almost entirely by real corporate dividends and actual earnings growth. Look at the data here. Speculative return, which again is just the change in what people are willing to pay for stocks based on emotion, added virtually nothing over the long run, just 0.1%. The real money comes from being a business owner, not a casino bettor.
But here is where the catch comes in. Let's look at Section 3, the tyranny of costs, Wall Street fees.
Remember that $10,000 investment we just looked at? The one that should have grown to $469,000? Well, if you pay an active mutual fund manager just a 2.5% fee every year, that exact same investment shrivels to just $145,400. Let that sink in for a moment. The Wall Street helpers literally confiscated over $323,000 of your potential wealth. Over an investment lifetime, those tiny little annual percentage fees snowball into a truly terrifying reality. In our example, the financial intermediaries put up exactly 0% of the capital, they took on 0% of the risk, and yet they effectively stole nearly 70% of your long-term returns. You are left with just 31% of what the market generously provided. Doesn't seem fair, does it?
Adding insult to injury, we have to talk about inflation, the silent thief. It constantly eats away at the real purchasing power of your dollars by an average of 3.3% a year. So when you combine the erosion of inflation with those high Wall Street fees, your real wealth can actually go backward. This makes minimizing those fees not just a good idea, but absolutely mandatory for your financial survival.
So how do we fix it? Let's dive into Section 4, the market basket, cut out the noise.
John Bogle, the absolute pioneer of the index fund, championed a beautifully simple concept. He realized that the grand illusion of Wall Street was convincing you that active stock picking actually works. Instead, he proved that simply buying the entire market and holding it forever is the only way to guarantee you capture your fair share of stock market returns.
Think of an index fund like a giant, simple grocery basket holding eggs of all sizes. The size of the egg represents a company's market capitalization, which is honestly just a fancy term for how much the company is worth. Instead of paying an expensive manager to constantly swap small eggs for big eggs, trying to guess which will hatch best, you just buy the whole basket for pennies. You hold it forever, effectively becoming a collective owner of all American business.
Which brings us to our final piece of the puzzle, Section 5, Patience Always Wins, the Power of Inaction.
This is exactly why you shouldn't panic during bear markets or get overly greedy during tech bubbles. Bogle warned us that expenses drag down your math, but emotions drag down your discipline. Buying high out of sheer excitement and selling low out of sheer fear is exactly how wealth gets destroyed. Patience, consistently, mathematically, outperforms emotional market activity every single time.
It's incredibly empowering to realize that just ignoring the frantic daily noise of the trading floor makes you mathematically far more likely to succeed. Think about it. The active trader is stressed out, churning their portfolio, constantly tracking the news, racking up taxes, and paying massive fees. The index investor? Totally calm. They are simply doing nothing, sitting back and reaping the quiet, compounding rewards of business ownership. So here is your exact blueprint moving forward. What Bogle likes to call the relentless rules of humble arithmetic. Own the entire market. Keep your costs rock bottom. Harness the miracle of compounding interest over decades, ignore the short-term noise of the news cycle, and most importantly, stay the course forever. This is exactly how you capture the positive-sum game of capitalism.
As we wrap up today's explainer, I want to leave you with this final, crucial thought. Every single dollar you pay in fees is a dollar you rob from your future self. So, are you going to keep paying the Wall Street casino to push your poker chips around? Or are you ready to buy the whole market basket and just stand there? Take control of your financial destiny today. Escape the tyranny of costs, stop gambling, and let time become your absolute greatest ally.